Hi there. Welcome to The Open here on BNN Bloomberg. I'm Lindsay Biscaya. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. The Bank of Canada is likely to hold interest rates steady at 2.25%. Since October, policymakers are saying borrowing costs are in the right place to support an economy that's impacted by the U.S. trade situation. Now, the war in the Middle East has added inflation risks and uncertainty. However, it's likely too early to signal any new direction. And shares of Macy's are soaring in the pre-market today. The retailer is forecasting stronger than expected sales in the current quarter as middle and higher income households continue to spend. However, Macy's full-year outlook came in below estimates as the department store chain remains cautious about the risks from the Iran war and U.S. tariffs impacting consumer spending. And Trans Mountain is planning a series of expansion projects for its main pipeline. The government-owned company says this will allow crude oil to flow faster and tankers to carry more volume by 2027. Trans Mountain says it already exports 60% of crude exported by tankers to Asia, adding the war in the Middle East and the U.S. military action in Venezuela are making the pipeline more valuable. About half an hour's time, markets will open, but we'll take a look at U.S. futures today. All trading down at the moment. The Dow, NASDAQ, S&P 500 all down by about 0.5 or 0.6% to start the day. Investors obviously watching here and south of the border for these rate decisions today coming from the Bank of Canada and the Fed. And we'll take a quick look at the TSX as well. Finished the day at just over, almost at 33,000 points yesterday. We'll continue to watch to see if there's any growth there today. And as we've been mentioning, we are expecting interest rate decisions today from both the Bank of Canada and the Fed. And our next guest says foreign exchange and rate traders are on tenterhooks as the central banks weigh the competing forces unleashed by the war in Iran. Let's bring in Carl Shimoda, Chief Market Strategist at Corpay, for more insight into what's going to happen today. It's good to have you join us. Good morning.
Good morning, Lindsay.
So we've got a little bit of time here to put in our last expectations before these rate decisions come out. We'll start with the Bank of Canada. What are you expecting to hear today from Tiff Macklem?
Sure. So, 45 minutes out, it's a great opportunity to have a forecast proven wrong really quickly. The expectation here in markets and I think across Bay Street is that we're going to see a hold. The key thing here is really what they say in combination with that. So, we're in a situation in which we know that inflation has trended down in Canada over the last year. We know that, underlying demand in the economy is quite weak, but we are facing this potential shock coming from higher energy prices on a global level. So, the expectation is that our policymakers will look through that they'll follow their traditional playbook and avoid overreacting to a change in commodity prices. But there's considerable uncertainty as to, how direct they are in confronting that sort of contradiction. So, the language that we're looking for today is very likely to be very cautious I guess hesitant in the sense that they're not going to commit to a future move up or down in interest rates.
I think that's such a good point, though, to look at what we're going to hear from the governor of the Bank of Canada and the Bank of Canada itself, right? Because although the expectation is, of course, that rates will be held steady, when you think about since the last rate decision, how much has changed and how different the world has become geopolitically since that decision, there's a lot of different factors that the governor of the Bank of Canada will be looking at moving forward, too.
That's right. The key thing, of course, is that the global environment has turned much more hostile. We are looking at, commodity prices remaining elevated for a prolonged period of time here. That does historically generate sort of distributional effects in the Canadian economy. Typically, what we see is the producer sectors, the energy sector in Alberta and Saskatchewan tend to perform relatively well. We tend to see, government treasuries being replenished in an event like this. But at the same time, the average consumer sees a hit to their spending power, and that's coming on top of the existing worries, which relate to the tariffs that the U.S. has placed on Canada over the last year, the decline in home prices, and the persistently high debt burdens that Canadians are carrying. So, Canadians at this moment are carrying the heaviest debt burden in terms of the amount of disposable income going to debt payment in the G7, and that's acting as a major sort of headwind to consumer consumption. Mm-hmm. So the bank is today going to have to really navigate its way between these contradictions, and I think the general outcome here is that they're going to say that we need to sit on the sidelines until we see how all of these trends intersect and ultimately drive the economy forward.
We've also got a decision coming from the Federal Reserve later today, south of the border. That's later this afternoon. Are there any changes in expectations in terms of what we could see there?
Right. So markets are very well aligned now with where the Fed was in December. In December, the Fed said that the median policymaker said that they expected to cut once in 2026. Markets did not believe that at the time. Markets were anticipating at least 2, maybe 3 cuts over the same time period. But since the invasion or the attack on Iran, that has pivoted. We're now looking at markets anticipating just 1 cut this year, and that's lining up, pretty well with what policymakers are expected to deliver today. However, the big question is, what does Chair Powell say during the press conference about how policymakers are viewing this inflation shock? And so, there is a possibility that he talks about more discussion among his colleagues going into the decision around the possibility of actually raising rates this year, right? So, we could see a fairly major hawkish surprise if he does deliver something like that. I don't think that he will. I think he'll be quite careful in how he frames it. But the reality here is that at least some policymakers on the Federal Open Market Committee at this point in time are very likely thinking, we should not be cutting rates, we should be hiking rates this year.
So interesting to watch all of this unfold. When today's 2 decisions come out, what do you think that will mean for the exchange rate?
Right. So the Canadian dollar, I think, is vulnerable to a little downside here in the coming hour, just on the basis that the Bank of Canada might sound more dovish than is currently priced in. They may, clearly signal that they're willing to look through this energy price shock and focus on the fundamentals in the Canadian economy, which remain very, very weak. And then on the other side, if we do see that hawkish surprise or we see a less than dovish approach from Chair Powell, the U.S. dollar may claw back some of the gains that it's been giving up in the last couple of days. Now, I should sort of note here that the Canadian dollar has been holding up relatively well in comparison with its global counterparts over the last couple of weeks, in line with the rise in crude prices. But at the same time, the U.S. dollar has been steamrolling all of its opposition. And so the Canadian dollar has ultimately been a bit weaker than the U.S. dollar over the last 2 weeks. So, yeah, going forward, the expectation here is that interest rates should drive more of that dynamic. We should see less focus on oil markets, and that should, drive the Canadian dollar slightly weaker over the next month or 2.
Well, that's what I was going to ask just before we wrap up here. Like, we've seen how the loonie is performing compared to the U.S. dollar. Is most of that because of what's happening with the price of oil and uncertainty over the price of oil?
Yes, exactly that. So, on one side, the price of oil climbing is boosting Canada's terms of trade, and that's translating into some strength for the Canadian dollar. But at the same time, we have a safe haven bid that is boosting the U.S. dollar. Investors around the world are cutting off some of their liabilities. They're pouring into the safest markets that they can find, which are, the U.S. Treasury markets, and that's driving the U.S. dollar higher. But yes, over the next month or so, that dynamic should shift. We should see a mission accomplished speech, as it were, from President Trump at some point, and some of that safe haven bid and the rise in crude prices should reverse themselves, and so we're bracing for a lot of turbulence in the coming weeks.
Okay, we will leave it there. Carl Shimoda, Chief Market Strategist at Corpay. Really appreciate your time and your insight today. Thanks so much for joining us.
Thank you.
Coming up, after the blackout left millions in Cuba, has finally reconnected its power grid and brought online its largest oil-fired power plant. So we'll bring you an update on what's happening in Cuba right after this. Stay with us. Cuba is restoring power after it experienced a nationwide blackout brought on by a dire energy crisis. Oil from Venezuela used to fire up the island's power grid, but that stopped flowing after the takedown of Venezuela's Nicolas Maduro by U.S. forces. So for more on the situation in Cuba, we're joined now by CTV's Scott Hurst. Scott, good morning. I wonder, how serious is this blackout crisis right now in Cuba?
Good morning. The humanitarian crisis in Cuba is growing increasingly grave, Lindsay. A U.S.-imposed oil blockade is crippling the Caribbean island nation's aging power grid. As you mentioned, Cuba was plunged into darkness this week by a blackout, the third major failure since December. Now, most of the nation's power grid, as you mentioned, came back fully online late yesterday, but shortages may continue as officials are warning the crumbling infrastructure and power network could fail again as it continues to degrade. And all of that is causing concern for the thousands of Cubans who've made Canada home. Of course, from a Canadian perspective, it is incredibly popular tourism destination, but as of 2021, the overall Latin population in this country is estimated to be close to 600,000, with Cubans being one of the proudly represented populations. Not a huge diaspora, with the largest presences, however, in Toronto and Montreal, though ultimately this collapse has cut off running water to many as well. And Lindsay, communications can often be spotty throughout much of the island.
Yeah, at a time when the people of Cuba have already been suffering so much. I wonder, too, we've heard U.S. President Donald Trump talking about Cuba over the last couple of days. How is he playing into this situation? The
U.S. president is escalating his warnings to Cuba, saying he would, quote, be doing something very soon, hinting at some imminent developments as the U.S. blockade has choked off oil supplies. Some of the critical shipments from Venezuela were halted in the wake of the American attack on that country, with the Trump administration demanding that Cuba release political prisoners, amongst other demands, for the very least, of lifting some crippling sanctions. Now, Trump has said quite bluntly that he might have, quote, the honor of taking Cuba, as both Trump and Secretary of State Marco Rubio have said that the administration sees the island nation as one of the next countries where the U.S. can ultimately try to expand its influence. Now, for its part, Lindsay, Canada late last month announced it would send an additional $8 million on top of existing support to the country as part of humanitarian aid, really a push to scale up food and nutrition programs, Lindsay, for a rapidly increasing need on the island nation.
Okay, that is CTV News' Scott Hurst joining us live for an update on the situation in Cuba. Scott, thanks so much for that.
Thanks, Lindsay.
Up next, shares of Lululemon are down in pre-market trading after the athletic apparel retailer issued weak guidance for the year. We will bring you that conversation right after the break. Stay with us. U.S. President Donald Trump says America no longer needs allied support in its war with Iran. The president justified the U.S. and Israeli war in Iran as he faced his first public defection. CTV's Joy Malvin has more.
Thank you very much for being here.
Greeting the Irish Prime Minister in the Oval Office, President Donald Trump lashed out at NATO and U.S. allies for not joining the war against Iran.
I think NATO's making a very foolish mistake, and I've long said that, I wonder whether or not NATO would ever be there for us. So this was a great test, because we don't need them.
As his top counterterrorism official just quit publicly, a stinging resignation, Joe Kent posted on X he could not in good conscience support the war, saying Iran posed no imminent threat to our nation, and it is clear that we started this war due to pressure from Israel and its powerful American lobby. A shocking surprise among the president's loyal ranks, Kent openly questioned the president's judgment.
He was weak on security. It's a good thing that he's out, because he said that Iran was not a threat. Iran was a threat. Every country realized what a threat Iran was.
The president praised his Arab allies taking the brunt of it after most NATO nations bowed out. France's President Emmanuel Macron said, France did not choose this war. We are not taking part in it. And from Britain's Prime Minister,
we will not be drawn into the wider war.
Trump wanted their help to safeguard the Strait of Hormuz, but it's risky. With tankers on fire, Iran has blocked the critical waterway for oil, sending gas prices soaring. Trump grumbled.
Everyone agrees with us, but they don't want to help. And we as the United States have to remember that because we think it's pretty shocking.
The president's pressure campaign on allies so far coming up empty. As for his timeline, Trump said the U.S. is not ready to leave Iran yet, but will in the near future. Joy Malbon, CTV News, Washington.
Lululemon shares are down in the pre-market after the company issued weaker than expected 2026 guidance. Our next guest is lowering her price target on the stock to $175. So we are going to welcome in now Dana Telsey, CEO and Chief Research Officer at Telsey Advisory Group. Good morning. It's good to have you join us.
Good morning. Thank you for having me.
So looking at these latest results, Lululemon beat its fourth quarter expectations, but issued weaker than expected 2026 guidance. How do you think investors should kind of interpret this disconnect between what we've seen and what we're expected to see from the company?
I think overall, they're still in the transition period of putting in new product in order to drive increased sales. The newness quotient is going up to 35% from what it had been, so there's a real pickup. As we go through the year, you'll see more of that newness come in. Don't forget the first quarter also, particularly in North America, you still have some of that tariff headwinds. And the real focus for Lulu is reducing markdown sales in order to return to full price selling, which is more expected to accelerate in the second half of the year.
Yeah, I wanted to talk about that, pulling back on promotions. The company was asked about this in their earnings call this morning. Didn't really give too much further insight into the reasoning behind this. I'm assuming you view this as a kind of necessary brand reset rather than something that might help the company or hurt the company rather in the short term.
I think overall, the fact that you bring in new product and they're beginning to see is what they call green shoots to that product acceptance. You don't need an accelerated path of markdowns as you're delivering newness. And interestingly enough, in my call with them yesterday after the earnings call, the goal to improve operating margins beginning in 2027 because the acceptance of this new product is very much front and center.
We know tariff impacts are rising for many companies to a net $220 million in 2026. So how damaging could that be to Lululemon's margin profile moving forward? Like, how much longer can these companies continue to absorb some of the cost of tariffs?
I think one of the things we've seen from all retailers is that they've become very agile. The fact that they've enhanced and advanced their supply chains, the fact that you're lapping tariffs, who knows where tariffs go in the future, but the innovation pipeline that companies are putting in place, including Lululemon, frankly, are driving more appeal. Also, keep in mind that with events like the World Cup coming up as we go through this year, also drives more people to buy new occasion wear. And we're seeing an uptick in the acceptance and the conversion of consumers reaching out for new product and being able to deliver sales growth as a result of that.
Has the company mentioned any other kind of realistic levers that they're planning to use to offset tariffs, though?
I think there's a lot of things. I think they continue to look at expense reduction opportunities, and I think you're going to see more from them there. I think you're continuing to see the opportunity on the newness and products, some of those higher AUR, average unit retail selling price upticks that you see from categories that can be more expensive. I think overall, keep in mind what you're seeing in terms of international, the sales growth from Lululemon overseas definitely is greater than what you see in North America, and you're continuing to see the majority of new store openings taking place in those overseas locations.
Yeah, it's interesting to watch kind of the global situation here because same-store sales in the Americas have been flat for the last 2 years. I'm wondering, like, how concerning do you think that is? There's a lot of growth in China, as you mentioned. Is that enough to kind of offset what you're seeing in the Americas?
Well, you want to see a return to growth in the Americas also, and I think that's what the focus is on, delivering more full price selling of these newer items. The stabilization and uptick, even on a steady state basis, when you have a company that's over $11 billion in sales, it takes a lot to move the needle. And therefore, that's why the green shoots of some of this new product acceptance in the Americas, along with the optimizations of stores, some increase, some new looks, will be able to help improve the trend direction, I think, of the Americas going forward.
How much of a distraction or potential catalyst is this kind of ongoing proxy battle that we're seeing with the founder, Chip Wilson? Like, what's that doing for the company? Is it hurting it? Is it helping it? What do you think?
I think it's a distraction. It certainly doesn't help. Obviously, it's also a cost also. Getting rid of that cost would be a help to the margins. I think they're still searching for the new CEO. That's still underway. So you have a lot of shift and change, but at the same time, they're continuing to execute on that core strategy of delivering newness, enhancing the customer experience, and activating, certainly with more investment in social channels of marketing to widen their reach.
Yeah, Chip Wilson obviously has been very vocal about who he thinks the next CEO should be, or throwing out a couple of different names. Like, how critical is it for this company to find a new CEO sooner rather than later?
Sooner is definitely better. They had the game plan in place. Certainly, you're beginning to see the green shoots, which is good. But you'd expect that within over the next 2 quarters or so, that there would be an announcement.
You've also maintained a hold rating while lowering your price target. So do you expect any changes to the outlook as we approach the spring season?
I think the only thing you could see is perhaps some better acceptance of full price sell-through. We know the headwinds on the margin sides, both with tariffs and costs. So in order to have a trajectory change, it would be an upside surprise on the top line, which frankly, as they pivot to more full price sell-through and the acceptance of newer product, that's what to look for going forward.
Okay, we will leave it there. That's Dana Telsey, CEO and Chief Research Officer at Telsey Advisory Group. Appreciate you joining us. Thanks so much for your time today.
Thank you very much.
And we're going to take a look at the markets very quickly, the U.S. futures, as we count down to the opening bells, which is coming up in just about 4 minutes' time. You can see the Dow future, NASDAQ, S&P 500 all trading down at the moment. Obviously, investors are waiting for these rate decisions today, particularly in the U.S. The Fed is announcing a rate decision later this afternoon. We've got the Bank of Canada's rate decision coming up at 10:30, so we will continue to watch that. It seems as though investors are a little bit cautious today, also watching that ongoing conflict in Iran, which is affecting the price of oil as well. We'll take a look at the price of oil, because we do have a moment to take a look at that. It is up at the moment 1.7%. So obviously we're watching developments there. Iran has been reporting new strikes on some energy assets in the Persian Gulf today, airstrikes from the U.S. and Israel. And so you can see the price of oil continuing to climb today. And gold is an interesting one that we're also watching today. It's continuing to fall. It's down by almost 3% to start the day. We're seeing some new lows for gold, down below 5,000 for the first time in quite some time. So we'll keep watching that as well. Stay with us. Opening bells are coming up next. And here are the opening bells at the NASDAQ. Rockton Red Bull Racing Academy program is ringing the opening bell. And at the New York Stock Exchange, Farmer Mac rings the opening bell. It's time now for the first 15. You are watching BNN Bloomberg. Trading is just getting underway, so we're going to check in on the equity market. We'll start with the TSX. It's down by 0.8%, finished the day down as well, down by more than 33,000 points yesterday. S&P 500 and the NASDAQ both trading down as well today. Investors watching, waiting for some decisions from key central banks here in Canada and in the U.S. Seems as though they're a little cautious ahead of these decisions, and we're watching for those. If we take a look at some of the companies we're watching today, some of the stocks, Couche-Tard is down by almost 3% to start the day, reporting third quarter adjusted profits that missed analyst estimates. And you can see that is reflected in the stock price today. So we'll keep watching to see where that moves. Coming up, though, the Bank of Canada's rate decision and some ideas for your portfolio right after this. Stay with us. Welcome back. For movers south of the border now, we are joined by Bloomberg's Janine Panzer to break some things down for us. Janine, it's good to have you join us. We'll start with Macy's. So they issued a prudent 2026 guidance on geopolitical risks. Tell us more about that.
Yes, so Macy's shares are up this morning after the iconic retailer posted its latest guidance, and the outlook is as weak as some analysts expected. What Macy's is doing now is that it's taking a cautious approach with its guidance because of the Iran war and tariffs. Two key metrics here for the full year forecast is expects adjusted EPS to range between $1.90 to $2.10, and also expects comparable sales to increase as much as 0.5%. As the largest U.S. department store chain, the company is gauging how American consumers' spending will respond to this uncertainty, how much people are willing to spend on things like clothes, accessory, home goods, and other non-essentials. The company says that higher tariffs will push up costs more in the first half of the year than the second. Bottom line here is that Macy's is doing fine now, but a reminder that retailers are getting more careful as consumers face more pressure.
And that seems to be a similar story, as you mentioned, like with different retailers as well, because we're seeing something similar from General Mills, another company you're following today, missing expectations, as this company says consumers are pulling back too.
Yes, exactly. General Mills, your breakfast staple, is in focus this morning because the shares are slightly down at the open. They missed the Wall Street expectation. The Minneapolis-based firm, which behind brands like Cheerios, Reese's Puff, reports a 3% decline in organic revenue, wider than estimates, and its adjusted EPS also trail expectation as well. So what's going on here? The company says that the drop in North America isn't a surprise and is largely in line with internal expectations. That comes after cutting prices about 2/3 of its business and divesting its yogurt business. The result shows the challenge facing General Mills and its competitors, which is getting people to keep buying packaged food as more shift towards fresher options and still want low prices. So looking ahead, the CEO says things should improve. He expects a pickup in sales and return to earning growth, pointing to market shares gain and easier comparisons.
Okay, that is Bloomberg's Janine Panzer joining us live today. Janine, thanks for that. Yesterday on Market Call, we were joined by Christine Poole. She's president and co-chief investment officer at Davis Ria, and she was covering North American large caps. Her top picks were Brookfield Corporation, Royal Bank, and Siemens AG. Today on the show, we have David Burrows. He's chief investment officer at Barometer Capital Management, and he'll be taking your questions on North American large caps. Coming up, we will get a money manager to weigh in on today's Bank of Canada's rate decision and some ideas for your portfolio. That conversation coming up right after the break. Stay with us. We are expecting a rate decision from the Bank of Canada at 9:45 Eastern Time today, and later today we'll find out the Federal Reserve's decision on rates. Meanwhile, oil prices remain elevated today. So let's find out what this means for the markets. Joining us now is Mike Vinokur, portfolio manager at Propellus Wealth Partners and IA Private Wealth. It's good to have you join us. Thanks so much.
Thanks for having me.
We'll start with the Bank of Canada's decision coming out very soon, actually. What do you expect to hear?
I expect to hear that they're monitoring what's going on in Iran with the hike in many commodity prices, how that may influence the CPI. But they're also probably going to highlight how the Canadian economy is soft and the real estate market is soft. and how they may need to potentially act sooner rather than later to help the consumer out with higher prices at the pump, but also interest costs.
So do you expect a rate cut or a rate hold today?
Tough question. I would not be surprised by either a rate cut or a rate hold with the promise of a rate cut if current circumstances, get maybe a little bit tighter. I don't know where their red line is right now in terms of initiating a rate cut, but we wouldn't be surprised to see a bit more easing.
Mm-hmm. Okay, a lot of factors, as you mentioned, go into this decision today, and we'll hear from Tiff Macklem later this morning about that. I wonder, what do you expect from the Federal Reserve later this afternoon, and how much what happens south of the border influences the Bank of Canada's decision here?
Yeah, we think that the Federal Reserve is a little bit more telegraphed in that they are going to stand pat and see how the economic data is delivered. The dot plots, if you believe in those, will tell you that there's probably 1 or 2 rate cuts this year. And given what we saw this morning with the producer price index, maybe that's even going to be diminished. We'll see how they react to the incoming data, but also how long this war is going to last and how that affects commodity prices, producer price index, and also the CPI for the average consumer.
Yeah, PPI coming in much higher than expected this morning in the U.S., so that's a good point as well. We spoke about, or you mentioned Iran and the situation in the Middle East off the top there, but I wonder if you can go into more detail just in terms of how this might influence decisions, because this conflict is so new. Is there time for the central banks to kind of wait it out and see what happens before making any decisions that are influenced by this war?
Yeah, there's always time. I don't think they need to take immediate action, but the tough decision here is we're right now evaluating the first order and second order effects of the closure of the Strait of Hormuz. And what I mean by that is a lot of the media is reporting how this is affecting oil and gas. But we don't hear potentially enough talk about all of the other products that aren't coming through, such as helium, fertilizer, a lot of petrochemicals. This will impact a lot of other industries other than energy, and that may cause a lot of logistics and supply chain disruption, but also a much bigger escalation in costs that we saw in the data today. And the data today was based on February, which was before the war started.
Mm-hmm. I do want to get to some stock picks that you have when we're looking kind of more overall at the markets just before we run out of time. So we'll go to those. First is Uber. That's one of the stocks that you like right now. Tell us why you like Uber.
Uber's just been an amazingly good company at executing their plan. They have a huge network effect with the global base of clients that they have. Some clients use Uber very frequently, some use it not frequently at all. But we think that there are many opportunities that will surface themselves in the not too distant future that will allow Uber to get its tentacles into many very different businesses other than the rideshare, the food delivery, and other logistics businesses that they're involved in that will be very high margin. And one of those we think is going to be advertising, sort of like Amazon, where consumers can receive an ad on their Uber app. The company is got a lot of free cash flow that they're generating. Their balance sheet is very strong. Their revenue is growing at a very high clip, and at less than 20 times forward earnings for such a juggernaut that has proven that they can enter new markets and defend core share position. We think this is going to be a winner.
And you also have Premium Brands as your pick today, trading on the TSX. What do you like about this one?
So a bit of a more defensive pick, especially in the environment that we're in. So Premium Brands manufactures and distributes different food items. They have been a serial acquirer of companies. They've proven a unbelievably good ability to acquire and then reap out the synergistic benefits in terms of costs out of the acquisition. They just made their latest acquisition, a company called Stampede Culinary Partners in the U.S. The other thing that we like about Premium Brands is that they have a very big and ever-growing foothold in the U.S. now, which sort of shields them, if you will, from the USMCA and tariff wars, if you will, that are going on right now between Canada and the U.S. We think that EBITDA is going to keep growing at a very solid clip. You're not paying a lot for the EBITDA. You're getting a great dividend yield right now, and you're buying the stock of a company that's proven to allocate capital extremely well in the past, and we think that that will continue into the future.
Okay, we will leave it there as we await this rate decision coming up in just a moment. Mike Vinokur, Portfolio Manager at Propellus Wealth Partners and IA Private Wealth. Really appreciate your time and your insight. Thanks so much.
Pleasure. Thank you.
And as I just mentioned, the Bank of Canada is set to announce its latest interest rate decision any moment now, in about a minute's time from now. So joining us live to break down what this is going to mean for the economy is Jason Daw, head of North American Rate Strategy at RBC Capital Markets. It's good to have you join us. Thanks so much.
Hi, good morning. Thank you for having me on.
Yeah, so just waiting for these numbers to come out. Oh, it looks as though they are out, and it looks as though rates are going to be held steady at 2.25%. So I was going to ask you what you expected. Is this kind of what you expected?
Yeah, it was largely expected by consensus. It was expected by the markets that there would be no change. A lot of it is going to depend on what the Bank of Canada says as far as the outlook going forward. And there has been a lot of cross currents that have been hitting the economy, both on the inflation and growth side. So the level of uncertainty is quite high, and that does argue for them to be on hold at this point.
I'm just going to look for more details in a moment, but and just in terms of keeping this rate steady at 2.25%. But as you mentioned, there's so many factors here that are fueling these decisions. It's so interesting to think about the last time we heard from Tiff Macklem announcing a rate decision, and what he was talking about and focusing on the most was CUSMA and the upcoming renegotiation of CUSMA, trade with the U.S. So much has happened geopolitically since then. What do you think some of the main focus points are for the Bank of Canada to be looking at this and making this decision now?
Yeah, the outlook was cloudy before the last couple of weeks, and it's got even cloudier with the issues that are happening with oil prices. So the economy has been facing a number of structural changes, whether that's on population, whether that's in our trade relationship for the U.S., and now another supply shock added into that. Oil further complicates the outlook because there is potentially, different factors that are happening on the growth and inflation side. And, all this does continue to argue for them being on hold for some time as they digest the information, because as the Bank of Canada said in January, uncertainty is high, and now uncertainty is even higher over the past 2 weeks.
Yeah, we've also seen signs of slower consumer spending here at home, rising mortgage pressure. How much is that weighing on the Bank of Canada's decision?
Overall, the economy for the past 12 months has actually been surprisingly resilient. The consumer grew close to 2% last year, so did final domestic demand. There was a lot of erratic data on trade and inventories, but the economy was generally pretty resilient. More recently, yes, the labor market has not looked all that great, but when you look at it over a longer term view of 6 to 9 months, there's been close to zero jobs created over that period, but population has been zero. So that is largely expected and largely consistent. Inflation has come down on the core measures. So, the path to them being able to cut rates if growth was a lot weaker going forward, that path is wider, but it's still overall, the outlook still points to a long period of being on hold.
Yeah, and I'm just looking at this statement now from the Bank of Canada talking about that growth, talking about the GDP numbers that came in the third quarter of last year, showing weaker than expected results in terms of GDP. And also, this statement really talking about the war in the Middle East, saying prior to the war, the global economy was on pace to grow at around 3%. So obviously what's happening in the Middle East really impacting the decisions here. Do you expect potentially down the road, or for Tiff Macklem to be referencing or hinting that maybe down the road later this year there will actually be rate cuts?
No, I think there's a more likely chance that they actually raise rates next, as far as the next move. But they could cut if inflation was contained and growth was weak. What we know from the oil shock that we're facing is that inflation is going to be higher on headline CPI. Whether there are second round effects that filter in to core measures, into the labor market, that is going to take some time, and they're going to need to see evidence of that before they decide what to do. So the inflationary side is clearly higher. The growth side is a little bit more complicated. The outlook for growth could be more neutral. It could be slightly positive, slightly negative with higher oil prices. But, again, we're going to have to wait to see how the evidence plays out. But, again, argues for a long period of hold. There is a chance of a cut. There's a chance of a hike. We think more likely the next move would be a hike rather than a cut.
Okay, I take your point on that. Looking at other factors here at home, like housing, always a major factor here in Canada. Lower rates later this year. I take your point. You don't think that's going to happen. But, I mean, what do you think how much is the housing market and what we're seeing with the housing market maybe going to influence decisions moving forward?
It's definitely one factor that they look at. It's not the only factor. There's a lot of issues going on with housing related to population, different things like that. So the housing market's been weak for a couple of years. It could soften maybe a little bit more. Prices maybe adjust a little bit lower, but the upside in housing is very limited. And I think the Bank of Canada recognizes that cutting interest rates just to help the housing market on its own is maybe not the right decision.
We're also watching for the Federal Reserve, of course, with their rate decision coming out later this afternoon. Any expectations in terms of what could happen there, and also how much that decision influences the Bank of Canada moving forward?
The Fed's widely expected to be on hold. Powell is probably going to use the language wait and see quite often in the press conference. They had more of an axe to cut rates going forward. The inflation side now with oil does complicate that a little bit. So they'll take a similar approach as the Bank of Canada, to be honest, as far as, they need to wait and see. They need to see how all this plays out in second round effects and the wider economy. In general, what the Fed does, not a big impact on the Bank of Canada. We've seen a lot of cases historically where the BOC is willing to go in its own direction and do its own thing based on domestic fundamentals and specifically a stronger inflation mandate compared to the Fed's dual mandate.
It's always so interesting to see where the focus is too, right? Like, as you mentioned, a lot of the focus is going to be on those oil prices. But in the past, or at least the last rate decision for the Fed, that focus was on Jerome Powell, his term ending, who as chair of the Federal Reserve, who will be taking that place. Do you think that's going to be a question that's brought to Jerome Powell today, or is the focus really, really has shifted to what's happening in the Middle East?
I think those questions have already been answered. We know, who's going to be coming in. I do think the questions will, more rest on the side of what's happening in the Middle East, what's happening with oil, how does that affect the Fed's outlook going forward.
Okay, we'll leave it there. Jason Daw, head of North American Rate Strategy at RBC Capital Management. Appreciate your time and your insight. Thanks so much. And we are going to take a short break right now. When we come back, we'll check in on the market and reaction to today's rate decision on Bay Street. Stay with us. Welcome back. Let's check in on the equity markets now that we have heard that Bank of Canada rate decision, keeping the overnight lending rate at 2.25%, so holding rate steady. And we're watching for reaction on the markets today in Canada. The TSX right now is down by almost a full percentage point. So we'll keep an eye on that to see how investors are reacting to this news. Also, of course, waiting for that update from Tiff Macklem, coming up at 10:30 today. So we'll watch for that. If we take a look at the financial sector on the TSX, this is how that sector reacting at the moment. So it seems as though it's trending up by 0.3%. So lifting up ever so slightly after this announcement from the Bank of Canada today. Here's how some of the big banks in Canada are doing. TD Bank currently trading ever so slightly up, basically flat at the moment, actually. Royal Bank of Canada up by 0.5%. The Bank of Nova Scotia up by 0.6% as we watch for reaction from this news. Bank of Montreal is up by 0.3%. National Bank also up, and CIBC also trading up at the moment. So we'll keep watching that. And it's going to be interesting to see which sectors and which companies are benefiting from this news today, which are not. Couche-Tard is a company we've been watching already today after reporting third quarter adjusted profits that missed analyst estimates. And you can see right now trading down to start this Wednesday morning by more than 3%. We're also watching Lululemon. We saw some, what many analysts would consider disappointing outlook to their latest reports, issuing weaker than expected 2026 guidance. And so you can see Lululemon stock actually is up by 2.5% today. They are shifting some strategies within the company. And so we'll have to keep an eye on how that goes over the next couple of months. We'll take a look at the loonie as well after this rate decision came out today from the Bank of Canada. The loonie is down at the moment compared to the US dollar. And we're also watching the price of oil. Obviously, this conflict in the Middle East, a real big factor here when it comes to what the Bank of Canada has decided today. You can see the price of oil up by 2.6% to start the day. We're also watching for developments in the Middle East. Iran reporting a number of US and Israeli airstrikes in the Persian Gulf coast. Still not seeing many tankers and ships moving through the Strait of Hormuz, and that is driving the price of oil up. And we're also watching the price of gold today. It's actually falling. It fell earlier this morning to a one-month low as investors focus on that rate path for both the Bank of Canada and the Federal Reserve. That decision coming out later this afternoon. And gold futures at the moment down by 2.7%. Coming up, we've got more on the Bank of Canada, which is continuing to hold that key interest rate at 2.25%. And we've got more on that after the break. Stay with us. Hi there. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following in the BNN Bloomberg newsroom. The Bank of Canada is holding its key interest rate steady at 2.25%, maintaining it at the same since October. Bank of Canada Governor Tiff Macklem says how long the Middle East conflict lasts and the extent to which it spreads will determine its impact on the Canadian economy. He also says the spike in energy prices will push up inflation in the short term. Macklem adds it is too early to assess the impact of the war on growth in Canada. And the Teranet National Bank Composite House Price Index fell for a third consecutive month in February. That index covers Canada's 11 largest markets. The number of homes sold in February fell for a fourth consecutive month. On an annual basis, a 4.4% decline was recorded from February of 2025. And on the upside, some Quebec and Prairie markets moved away from the trend and posted growth last year. And Trans Mountain is planning a series of expansion projects for its main pipeline. The government-owned company says this will allow crude oil to flow faster and tankers to carry more volume by 2027. Trans Mountain says it already exports 60% of crude exported by tankers to Asia, adding the war in the Middle East and the U.S. military action in Venezuela are making the pipeline more valuable. And we're watching reaction to Canadian markets today to the Bank of Canada's decision to hold rates steady once again. You can see the TSX is down to start the morning by 0.8%, almost a full percentage point. And of course, we're also waiting for the Federal Reserve's decision later today. That's coming out this afternoon. Watching U.S. markets to see how they react to that news and how they're reacting ahead of the news. It seems as though down as well to start the morning. S&P 500, Dow Jones, and NASDAQ all trading slightly down. And as we mentioned, as expected, the Bank of Canada is continuing to hold interest rates despite concerns about inflationary pressures from the conflict in the Middle East. And here to tell us what we learned from today and what this decision signals about the central bank's path forward for the rest of the year is Andrew Kelvin, head of Canadian and Global Rate Strategy at TD Securities. It's good to have you join us. Thanks so much.
Thanks for having me. It's always a pleasure.
So we are going to hear from the governor of the Bank of Canada in about half an hour from now, but we do have a statement. It does seem to focus a lot in that conflict in the Middle East in terms of the decision today. Do you think that factored into that decision today? I mean, we did kind of expect this already because it was alluded to by Tiff Macklem in the past.
Yeah, it absolutely did factor in. The Bank of Canada finds itself caught between a bit of a rock and a hard place. The thing I thought was interesting that we learned in this statement was that the Bank of Canada is actually quite concerned about the near-term outlook for growth. They did signal that the risks around the near-term growth profile skewed downwards. And they declined to make an assessment on what high oil prices will mean for the Canadian economy, because the knee-jerk reaction would just be to say, oh, high oil prices are good. We're a big energy producer. But they seem a lot more focused on the tighter financial conditions, which is what's happened in equity and bond markets. They seem to focus on the potential for supply chain disruptions. So I think what it tells you is that they are still pretty concerned around the state of the economy. But at the same time, with oil prices rising, they are determined not to let inflation get out of control again, because what happened twice on Governor Macklem's watch, I think is something he'd regret deeply.
What do you think about that? Because I'm sure Tiff Macklem will be asked about how these high oil prices are affecting Canada's economy today at 10:30. But do you think it's been a benefit for Canada's economy, or do you think it might be a drag, or does it depend on where you're talking about?
If things stay where they are today, which is to say interest rates do not move higher further up the curve from here, we don't see further tightening financial conditions broadly, I would look at sort of $9,500 oil as a positive for Canada's economy on net. It will hit the household sector negatively, certainly, but it will benefit our energy sector substantially. And our sort of rule of thumb is that a 10% increase in oil prices tends to add maybe a tenth of a percentage point to Canadian GDP growth. So if we could stabilize at these levels, I think it would be on net a positive thing for the Canadian economy. It's just given that this is a supply shock, given this is something that's geopolitically driven, and we saw even in January, the Bank of Canada was quite concerned about geopolitical uncertainty. I'm just going to suggest that uncertainty has not declined in the last few months. And those things can have sort of second order effects, which can offset that boost from higher energy prices in our terms of trade.
Yeah, I take your point that uncertainty definitely has not declined. Is there a risk, though, of maybe reacting too soon to this conflict in the Middle East?
I think there's a risk. I think that's why they're trying to play for time here. It's hard to predict sort of the path of the economy in the best of scenario with the duration of the conflict in the Middle East being still still unknown. It's very hard for the Bank of Canada to make an assessment about what this is going to mean for the Canadian economy. So I think the smart thing for them to do is to sort of sit on their hands here, give themselves maximum optionality. If they decide they need to hike in 3 or 4 months, which I don't think is likely, but if they decide they need to do that, they can say, that they haven't tied their hands here. If they decide they need to provide more stimulus, they can do that too, because they have sort of signaled they're concerned about the near-term state of the economy. So they're maintaining optionality. It's probably the best thing they could be doing here.
Yeah, concerns about the economy. So those are some of the geopolitical factors. Factors here at home, though, that you think the Bank of Canada might be looking at. Obviously, in this statement, the GDP, Canada's GDP contracting was referenced. We're seeing, Canada's housing market is a little bit cooler. We're seeing jobs numbers coming out with a loss of jobs in the month of January, I believe. What factors are most important here in terms of these rate decisions?
I mean, all these things are important. If the labor market remains in a weakened state, that's something that is going to give them a concern around the path for future inflation, the path for future growth. The bank is going to be looking, I think, very intently at the health of the consumer. Household spending is the biggest part of economic activity in Canada. Households are feeling the pinch from high food prices, which I did reference. Even with inflation now coming a little bit lower in some of the recent prints, I think if you talk to most households, they will tell you that high pricing levels are still a significant concern for them. So they are going to be really focused on the health of the household sector. If households find they need to pull back a little bit more, particularly in the context of falling population growth, that's something that I think the Bank of Canada would feel like they might need to provide a bit more stimulus in response to.
When we talk about reaction to this decision today, we're going to be watching for that throughout the day, obviously. But let's start with the loonie. What do you expect to see in terms of how the loonie reacts to the decision to hold rate steady?
I mean, I think given the tone of this statement being a little bit on the dovish side, it would make sense to me that the Canadian dollar has declined a little bit, but not a lot. Markets were anticipating the Bank of Canada remain on hold, and markets are priced for the Bank of Canada remain on hold for the next few meetings. This statement, given that the bank was again trying to maximize optionality, they didn't commit to staying on hold for the remainder of this, or put differently, they didn't commit to not hiking rates for the remainder of this year, because markets have priced in a Bank of Canada rate hike by the end of 2026. I think to see the loonie weaken further here, you would need to see that hike pricing disappear, and the Bank of Canada would need to say something a bit more declarative, I would say, for markets to really give up on the idea that high oil prices are going to lead to higher policy rates.
When we're looking at these high oil prices and reaction to that, when it comes to business investment and productivity, do you think you'll see more business investment because of these higher oil prices?
I don't. It's a great test, I suppose, that of the new government's attempt to make a more business-friendly environment for our resource sector. But what we've seen over the past decade or so is that the energy sector has not been as sensitive in putting forward large new capital expenditures in response to fluctuations in energy prices. These are long-term projects, and given that it's really hard to make a call on the duration of this energy price shock, it would be, I think, difficult to argue for a company making a 7 to 10 year investment on the basis of what could be a short-term disruption in oil supply. So I would be surprised if businesses were to be rushing to deploy capital here, particularly in the context of, again, what is a pretty uncertain global environment, which is something the Bank of Canada has been focused on for the last 3 months now.
And just lastly, before I let you go, obviously we've got the Federal Reserve coming out with its decision later this afternoon. And this comes as we see U.S. PPI numbers coming out this morning, much higher than expected. What do you think will happen in the U.S. with the Federal Reserve?
We think the Federal Reserve will also remain on hold. We'll probably have a couple dissents looking for rate cuts. But at the end of the day, with inflation where it is in the United States, with the U.S. economy still on pretty good footing, even with some weaker data in recent months, we think that Chair Powell will preserve the interest rate at 3.75%. We see rate cuts as a later in the year story.
Okay, we'll leave it there. Andrew Kelvin, head of Canadian and Global Rate Strategy at TD Securities. Thanks so much for joining us.
Thanks for having me. Always a pleasure.
Well, coming up, a U.S. trade representative says trade talks with Canada have fallen behind those with Mexico. We've got more on that coming up next. The legendary PEI potato will be headed to Mexican markets and eventually Mexican dinner plates. The Canadian Food Inspection Agency announced a deal with its Mexican counterpart to export fresh Canadian potatoes. And for PEI growers, it's a much-needed boost. CTV's Maria Saru has more in this report.
In PEI, there's a frontrunner for the kind of spuds most likely to be sent south, russets.
For the most part, we would be trying to provide the Mexican people with something that they don't have on offer down there, not in direct competition with, the varieties that they grow.
Canada's potato industry relies heavily on one key buyer. The U.S. is by far the most important market, taking 93% of the country's fresh exports by dollar value in 2024 to 2025. So, with some uncertainty about the future of CUSMA and North American trade, the industry says diversification helps.
It's always good to have new markets that are tariff-free or where you can have a bilateral agreement between the countries are especially advantageous.
Canada already ships frozen potatoes to Mexico, but the new agreement announced last week by Canadian and Mexican food safety officials allows shipments of fresh Canadian potatoes. It's a market that's been solely supplied by the U.S. in recent years. But while U.S. potatoes are trucked across Mexico's northern border, maritime shipments will likely arrive by boat to southern ports, says Ray Keenan, CEO of Rolla Bay Holdings, who was part of the delegation that explored this export opportunity.
We won't be going anywhere near the north of Mexico with our product. We'll be going further down.
While this agreement gives the industry permission to build a trade pipeline, planning is still in the early stages. The hope, however, is to ship potatoes going into the ground this year. Maria Saru, CTV News, Charlottetown.
Okay, let's take a quick check on the equity markets here. We're watching the TSX today. Reaction to this news that the Bank of Canada is going to hold rate steady once again at 2.25%. And you can see the TSX trading down at the moment by more than a percentage point. We're also watching the financial sector to see reaction pouring in as well. It's trading up at the moment by 0.3%. And if we look closer into the financial sector at some of the big banks in Canada, it seems as though, things have changed a little bit. TD Bank is now trading down. It was up a few moments ago, but it's basically flat. Same with the Royal Bank of Canada and the Bank of Nova Scotia as investors price in this news. And Bank of Montreal, National Bank, CIBC, all trading down ever so slightly at the moment, except BMO, which is down by 0.4%. We'll look at some companies that we're also watching for today. Couche-Tard reported third quarter earnings that missed adjusted profits, missed analyst estimates, and we're watching reaction there. Still, Couche-Tard down by more than 3% to start the morning. We are also watching shares of Lululemon. We saw a disappointing outlook, also as adding urgency to a CEO search. Of course, this company has been without a CEO for some time now, looking to kind of refresh. You can see Lululemon is actually trading up by more than 3% after these weaker results in their latest quarter. Earlier today, shares were down, but it seems as though investors buying back in at the moment. We're watching Lululemon closely to see what happens there with that Canadian company. We're also keeping an eye on the loonie today, again, watching reaction from the Bank of Canada's rate decision announcement this morning. Of course, we're going to hear from Tiff Macklem coming up at 10:45 Eastern time, so we'll be taking that live. But in the meantime, the Canadian dollar touches a session low after the Bank of Canada noted the weak economy that Canada is seeing right now. One of the many factors that has played into this decision to hold rate steady at the moment, and potentially we'll have to watch to see what's down the road later this year in terms of decisions. Canadian dollar down by 0.1% at the moment. And we'll take a look at the price of oil, another big factor that was in Tiff Macklem's statement today about the decision to hold these rates steady. So price of oil up by 2.7%. Obviously, this conflict in the Middle East is continuing. We're not seeing many more tankers or shipments of oil moving through the Strait of Hormuz, which is still being controlled by the regime, driving oil prices up. And we're also watching the price of gold, which has been hitting a low that we haven't seen in some time. Gold has been hovering above 5,000 for a few days now, a few weeks. And now it is below that mark. It's down by 2.5% at the moment. And we'll also just take a quick look at U.S. markets before we move on here. You can see the S&P 500, Dow Jones, NASDAQ, all trading down ever so slightly. Of course, we're also watching for the Federal Reserve's rate decision that's coming out later this afternoon. U.S. Trade Representative Jamieson Greer says trade talks with Canada have fallen behind those with Mexico as the administration prepares for this year's review of the U.S.-Mexico-Canada Agreement trade deal. So for more, we're joined by Bloomberg's Washington correspondent, Tyler Kendall. Good morning. So tell us more about what we're waiting for in terms of this renegotiation and what's happening.
Yeah, hey, Lindsay. So these comments from the USTR, Jamieson Greer, were brief, but they did send a message that isn't necessarily surprising if we think about how tensions have been escalating between this White House and Canada, particularly when it comes to trade. And as Bloomberg News reports, that President Trump has privately raised withdrawing the U.S. from USMCA altogether, though, of course, that would require a 6-month notice. The trade representative, rather, has been a little bit more cautious in his remarks, saying that there are parts of this deal that are fine and really should remain in place. Our own analysts at Bloomberg Economics have put out their projections as the trade talks are set to formally start next week, saying that there are two main paths that we could likely see. One would be an extension for another 16-year term, restarting this 6-year review cycle. But they think what is more likely is that we could see this move to an annual review cycle. Because of a few different factors here, including that the Trump administration wants to keep negotiations going and keep their own leverage when it comes to the discussion. We have to keep in mind the White House's perspective in a lot of this is that Prime Minister Mark Carney had campaigned on countering President Trump's trade agenda, and that has stirred up a lot of, I think it's fair to say, tensions between the two nations, particularly when it comes to trade. And while we do see the bulk of Canadian goods, for example, protected from USMCA, we know that there has been this frustration when it comes to some of those sector-specific tariffs, including on steel and aluminum, which still face very high rates. Now, the USTR Greer did confirm that he had met earlier this month with Canada's trade minister, who has said, quote, he's not pessimistic about the talks and that he's expecting targeting changes rather than a full renegotiation of the trade deal.
Okay, that was Tyler Kendall with the latest on those renegotiations coming up this summer. Tyler, thanks so much for that. Coming up, we will get reaction to today's Bank of Canada announcement from Jeremy Cronic, President and CEO of the CD Howe Institute. That's coming up right after the break. As expected, the Bank of Canada maintained its key interest rate at 2.25%. And here to share his perspective is Jeremy Cronic, President and CEO of the CD Howe Institute. It's great to have you join us. Thanks so much.
Thanks for having me.
So you say that this was the right call to hold rates steady, at least for now. You also say there's two factors that really stand out in terms of making this decision and in terms of uncertainty, right? That's the conflict in the Middle East and the outcome of the CUSMA review.
Yeah, that's right. So both those two items have a fair amount of uncertainty attached to them. We don't know how long the war is going to last in Iran, and obviously the renewal of CUSMA and the negotiations around that are continuing. And so when you have that much uncertainty, often the right call from a monetary policy perspective is to leave the overnight rate unchanged.
And we've heard Tiff Macklem in previous rate decision announcements talking about this upcoming CUSMA review, right? Like, it's been on the radar for some time in terms of fueling uncertainty in our economy. This war in the Middle East is so new. Like, how much do you think the Bank of Canada factored in the conflict in the Middle East into this latest decision?
Well, I mean, I think they had to factor it in quite a bit. The challenge here with the war in Iran, I mean, there's many, but from a monetary policy perspective, is obviously there's a huge impact on oil prices and therefore on gas prices. And consumers disproportionately, when they think about inflation and what they think the level of inflation is, they often tie it to gas prices and food prices. And we were already having large increases in food prices over the last few months, and now we're seeing large increases in gas prices. And you can see a world where that can quickly kind of destabilize or de-anchor inflation expectations, and that can be a real problem for monetary policy. But for now, in the short run, where we don't really know how long the war is going to last, it makes sense to kind of look through that particular shock. But for how long is the question?
Yeah, and you say as well in your op-ed that this surge in terms of gas prices has not really fed into the inflation numbers just yet. Like, we're going to see that next month. So what do you expect in the coming months in terms of rate decisions from the Bank of Canada, and also what we're going to hear from Tiff Macklem today on that front?
Well, the problem is that sort of you have this what we call supply shock, which is causing inflation in overall inflation and driven by the gas prices and the food prices. But we also have weakness on the demand side. I mean, the labor market statistics last week were quite poor. We lost 84,000 jobs. More than 100,000 of those were full-time jobs. The unemployment rate went up. And the only reason it didn't go up more was because the labor force participation rate actually fell. And so you have inflation on the one hand and a weak demand on the other hand. That's that sort of stagflation scenario that's always concerning for a central bank. So, I'm curious to see what the governor and governing council have to say about those two things and where they see those things progressing over the next few months.
And on the CUSMA renegotiation front, that's coming up in a couple of months now. What do you expect to see in terms of that and how that has really factored into this decision today, and then again, also going forward for the Bank of Canada?
Yeah, so I mean, it's interesting. I mean, obviously the Supreme Court ruling at the end of February threw a little bit of more uncertainty, I should say, into what's happening. The Trump administration quickly pivoted, creating a global tariff of 10-15% under a different part of the Trade Act. But in terms of these renegotiations that are upcoming, I still have to believe that the administration sees value in the trade agreement, and that's why they've sort of still kept, despite this kind of change in tariff approach, CUSMA still is sort of the dominant feature, and so we're still facing lower tariffs than other countries are. So hopefully, I'm hoping that we're going to see continued progress on the renegotiations, and the central bank won't have to do anything drastic in response. But again, there's a lot of uncertainty around that. We just don't know.
Yeah, it just seems like there is, as you say, so much uncertainty. Is there room maybe for Canada's economy to benefit from some of this, maybe not uncertainty that we're seeing, but at least from the high oil prices, or any room for Canada's economy to grow over the next couple of months and rebound?
Yeah, so I mean, so when oil prices go up and gas prices go up, I mean, there's some value there to Canada, obviously as a net exporter of oil, but at some point that only lasts for so long. Once it gets too high, there's a real negative impact on global growth, which then feeds into Canada's growth rate. And so there's a limit to how much we can gain from higher oil prices, and I think we're probably going to hit that limit if we haven't already hit it pretty soon.
We're also watching the Federal Reserve, of course, coming out with its rate decision later this afternoon. What do you expect to hear there?
Well, they're also facing somewhat of a similar scenario in the sense of, there's been some labor market weakness, but inflation's been stubborn. There's obviously been this push from the administration to see lower rates, but there's been some pushback from voting members of the Fed. Because of these two conflicting situations where you've got sort of weak demand, but you've got still, somewhat elevated inflation. And so I'm not quite sure where they'll net out on this. I think it's complex, but I would probably expect them to keep their rate unchanged as well.
Okay, we'll leave it there. Jeremy Cronic, President and CEO of the C.D. Howe Institute. Really appreciate you joining us. Thanks so much.
Thanks for having me.
Coming up, we are gearing up for the Bank of Canada's press conference. That's just moments away now. We'll take that live for you when it begins. Stay with us. Trans Mountain is planning a series of expansion projects for its main pipeline. The government-owned company says this will allow crude oil to flow faster and tankers to carry more volume by 2027. Trans Mountain says it already exports 60% of crude exported by tankers to Asia. Adding, the war in the Middle East and the U.S. military action in Venezuela are making the pipeline more valuable. The Bank of Canada left its key interest rate on hold at 2.25%, maintaining it the same since October. Bank of Canada Governor Tiff Macklem says how long the Middle East conflict lasts and the extent to which it spreads will determine its impact on the Canadian economy. He also says the spike in energy prices will push up inflation in the short term. And Macklem adds that it's too early to assess the impact of the war on growth in Canada. Okay, and we're going to take you to Ottawa now, where the governor of the Bank of Canada, Tiff Macklem, and Senior Deputy Governor Carolyn Rogers are starting their press conference, and we're going to listen in live.
At this level since October. L'économie canadienne reste confrontée à l'incertitude élevée.
The Canadian economy continues to face heightened uncertainty related to U.S. trade policy and geopolitical risks. Now the war in Iran has added a new layer of uncertainty. Its impact on the global and Canadian economies will depend on how long the conflict lasts and the extent to which it spreads across the Middle East. Inflation in Canada has been close to the 2% target for more than a year. But as we've seen, the war in Iran is causing oil prices to move sharply higher, and this will push up inflation in the short term. Canada's economy is dealing with a lot, and now we face more volatility. The Bank of Canada's role is to be a source of stability. We are supporting economic activity while ensuring that a jump in energy prices does not turn into persistent inflation.
The Canadian economy continues to face heightened uncertainty related to U.S. trade policy and geopolitical risks. Now the war in Iran has added a new layer of uncertainty. Its impact on the global and Canadian economies will depend on how long the conflict lasts and the extent to which it spreads across the Middle East. Inflation in Canada has been close to the 2% target for more than a year now. But as we've seen, the war in Iran is causing oil prices to move sharply higher, and this will push inflation up in the near term. Canada's economy is dealing with a lot, and we now face more volatility. The Bank of Canada's role is to be a source of stability. We're supporting economic activity while ensuring that a jump in energy prices doesn't turn into persistent inflation. So let me expand on what we've seen in the economy since we published our January monetary policy report and what we see ahead. Recent data show the Canadian economy remains in excess supply and is growing slowly as it adjusts to U.S. tariffs and uncertainty. After growing 2.4% in the third quarter of last year, GDP shrank by 0.6% in the fourth quarter. This was weaker than we forecast at the time of the January MPR, but that's mainly because inventories were drawn down more than we expected. Domestic demand actually grew by 2.4% because of the strength in consumer and government spending, although housing was weak. Data received for early 2026 suggests the economy is expanding again, but at a slower pace than we had forecast in January. The labor market remains soft. The job gains we saw late last year were largely reversed in the first 2 months of 2026, and the unemployment rate rose to 6.7% in February. Recent trade data have been volatile, but they suggest growing weakness in exports. Inflation eased further to 1.8% in February, down from 2.3% in January. CPI inflation, excluding taxes, and measures of core inflation have also come down and are all now close to 2%. Food inflation, however, remains a problem. Food inflation slowed in February but is still elevated. The recent sharp increase in global energy prices is causing higher prices at the pump, as we've all seen, and this will push inflation up in coming months. It's still too early to assess the impact of the war on growth in Canada. If higher oil prices are maintained, this will boost incomes from our energy exports. At the same time, higher oil prices squeeze consumers, leaving them with less income for everything else. Beyond the jump in energy prices, the war in Iran will affect households and businesses in other ways. Financial conditions have already tightened. Global bond yields are higher, stock markets are lower, and credit spreads are wider. Transportation bottlenecks caused by the effective closure of the Strait of Hormuz could also impact the supplies of other commodities, like fertilizer. In its monetary policy deliberations, Governing Council is considering both the most likely path for the economy and inflation and the risks to the outlook. Uncertainty is acute. Trade and geopolitical uncertainties remain, and the conflict in the Middle East has broadened the range of possible outcomes. Relative to our January forecasts, risks to economic growth are tilted to the downside. Near-term growth looks weaker than expected, and the review of the Canada-United States-Mexico agreement is still a big unknown. At the same time, risks to inflation are tilted to the upside because of the sharp increase in energy prices. Economic weakness combined with rising inflation is a dilemma for central banks. Increasing interest rates to slow inflation could further weaken the economy. Easing interest rates to support growth risks pushing inflation well above target. Canada's outlook is further complicated by structural change, shifting trade relationships, the adoption of AI, and changes in demographics. With inflation close to target and the economy in excess supply, the risk that higher energy prices quickly spread to the prices of other goods and services looks contained. But the longer the conflict lasts and the wider it gets, the bigger the risks. Governing Council will look through the war's immediate impact on inflation. But if energy prices stay high, we will not let their effects broaden and become persistent inflation. À notre réunion cette semaine, on a décidé de maintenir le taux directeur à 2,25%.
At our meeting this week, we decided to maintain the policy rate at 2.25%. As the outlook evolves, we stand ready to respond. We are continuing to assess the impact of U.S. tariffs and trade policy uncertainty and how the Canadian economy is adjusting. We are also closely monitoring the unfolding conflict in the Middle East.
At our meeting this week, we decided to maintain the policy rate at 2.25%. As the outlook evolves, we stand ready to respond as needed. We are continuing to assess the impact of U.S. tariffs and trade policy uncertainty and how the Canadian economy is adjusting. And we are closely monitoring the unfolding conflict in the Middle East. The bank is committed to ensuring that Canadians continue to have confidence in price stability through this period of upheaval. And with that, the Senior Deputy Governor and I will be very pleased to take your questions.
Okay, thank you, Governor. We will go to questions now. We'll start with the reporters who are here in Ottawa at the bank, and then we'll go to those who joined remotely. As usual, I'm asking everyone to limit yourself to one question, please. That way we will have a chance to get to every media outlet. If I forget to do so, please state your name and affiliation. For those in the room, please activate the microphone by pressing the button in front of you so that everyone can hear your question, and press it again to turn it off once you're done. Avant de poser votre question,
Before asking your question, please identify yourself. And of course, please feel free to ask your question in the official language of your choice.
On this side of the room as I'm looking at it, and I'll start with Mark Rendell of the Globe and Mail, please.
Hi, Governor. Mark Rendell with the Globe and Mail. You spoke about how it's too early to tell whether the Middle East is going to be, like what the impact on the Canadian economy is going to be. I'm wondering, in general, is a oil price increase like this net positive or net negative for the Canadian economy? And if there's kind of a question of duration, like it's a short-term shock to consumers, but a longer-term potential benefit to oil producers and oil-producing regions, like how long does that duration need to happen before it shifts from net negative to net positive?
So, yes, there are multiple effects of higher oil prices on the Canadian economy. And as you suggest, it depends very importantly on the duration. So, I checked the screen before I came down. WTI was $98, $99. So, if oil prices stay high for an extended period, that does mean that the income coming into the country from our exports of oil, we are a net exporter of oil and natural gas, those incomes will be higher. That will tend to support the economy. The other side, of course, is that for consumers, for most businesses, most other businesses, higher oil prices are going to squeeze them. They're going to, for households, if you're spending more to fill up your car, you got less money to spend on everything else. That'll tend to hurt consumption. And for businesses, they're getting, their profit margins can get squeezed as they have higher energy costs. There are also some other effects, though. As I mentioned, since the start of the war, you've seen some tightening in financial conditions. Stock market's down, bond yields are up, credit spreads have tightened. So, that's also impacting Canadians. And then, I think the longer this conflict goes on, there is more potential for wider implications. Oil and natural gas are not the only commodities that go through the Strait of Hormuz. Other petrochemical commodities, fertilizers in particular, go through. If they're blocked, that will have other global impacts. So, all to say, I think the short answer, is it's too early to assess the effect on growth. It's going to depend on. It is going to depend importantly on duration, and it's going to depend on sort of how this conflict materializes. I think, I think what we can say is that certainly if it lasts, it's whether it's net positive or net negative, I think you will see some shifts in the composition of growth. Obviously, the energy sector will do better. Consumers will be more squeezed.
Okay, we'll go to Craig Lord from the Canadian Press, please.
Hi, Governors. Thanks for taking our questions. How is the Bank of Canada thinking about food inflation right now? Are impacts there, in your view, mostly transitory compared to exchange rates and the upcoming energy price influence, or is it becoming a more persistent problem in the wider inflation basket?
Yeah, we have been looking at this closely. I'll ask Kellen to say a few words on this.
Yeah, I mean, the governor mentioned this in his opening remarks. I mean, we're starting from a position where food inflation continues to outpace headline inflation a bit. It's certainly adding to that sense of affordability that Canadians are feeling. Energy shocks can affect food prices, and again, it comes back to the previous question. It depends a lot on duration. We import a lot of our fresh foods, so transportation costs add to food costs. There's inputs to fertilizer costs that are being affected by the war in Iran, so that if that persists, that could have a longer-term effect on food inflation too. So again, we're back to it's a bit early to tell what the effects on food inflation will be, but certainly energy is a big input cost to food.
All right, we'll go to Greg Quinn from Market News, please.
Good morning. The statements use the word dilemma to describe the risks of economic growth and faster inflation. That sort of implies a balanced approach, but you also have new language about higher energy prices and a lack of tolerance for that becoming sticky inflation. So is this really a situation where your view of policy moves is equally balanced, or do you have the thumb on the scale towards a potential increase?
Look, I think the short answer, Greg, is uncertainty is high. Since we published our forecast in January, we've seen some evolution of the risks, as I outlined. We're going to be seeing how those evolve, how those materialize, and we're prepared to respond as needed. I think there are really two main things we're watching. Obviously, the war in Iran. We're in week 3. This is an economic shock. How big it is going to depend a lot on how long it lasts, whether it widens, how disruptive it is. Here in Canada, we are starting from a position where inflation is 2%. It's actually been close to 2% for more than a year. Our measures of core have been decelerating, and the economy is in excess supply. So, what that tells us is that, the risk that higher energy prices are going to quickly spread to other goods and services, that looks contained. That doesn't look too high. So we've got some time. So it made sense to hold today. We know inflation is going to go up in the near term. We've all filled up our gas. We've all filled up our car. We've seen the prices at the pump. That's going to show up in March CPI. The issue for us is not really the immediate increase in inflation. We know that's going to happen. It's does that start to get generalized, start to spread, start to look more persistent. That's certainly what we're going to be looking for closely. The other thing, though, we're continuing to look at and assess is the impact of higher tariffs on the economy, the impact of trade uncertainty, the structural change that the Canadian economy is going through. Higher tariffs have weakened the Canadian economy. That will put some downward pressure on inflation. So, we've got to look at the whole situation. We've got to look at how the risks evolve, and we'll take it one meeting at a time.
Okay, we'll stay over here on this side of the room. Mackenzie Gray, please, from Global.
Hi there. In this dilemma with the potential inflation risks in Iran and, of course, the outstanding issues we've seen around trade with the U.S., what do you view as the biggest risk between those two issues to the Canadian economy right now?
Well, look, as I said, I think we've got to look at the whole situation of the economy, and growth and inflation are related. There are also additional cost shocks coming through energy prices. So I don't think it's a matter of sort of saying one thing is bigger than the other. You got to look at the whole thing together. I'm not sure I can be much clearer than that.
Okay, and over here, Annie Bergeron-Oliver, please, from CTV.
Hi, Governor. You sort of touched on this, but you mentioned that the longer the conflict goes on, the wider it gets, the bigger the risks are. I'm wondering if you can talk a little bit about what those wider implications are on the economy, what you're most concerned about, and how concerned consumers should be about inflation over the coming months.
Well, look, the first thing I want to say is that, the biggest cost of the war in Iran is a human tragedy, but it's also an economic shock. And the fact, in particular, the fact that the Strait of Hormuz is essentially closed is cutting off a significant amount of global supply of energy. In Canada, that's not affecting us very directly, but when there's less supply globally, prices are higher globally. And you've seen a sharp increase in the global price of oil. Brent's over $100. As I mentioned, WTI was about $98, $99 when I came down. The impact that will have on economies is going to depend a lot on how long it lasts. And as I mentioned, energy is not the only thing that's going through the Strait of Hormuz. So, in the short run, people have, companies have inventories, countries have inventories. They can manage. But the longer it goes, those inventories get depleted, and that shortage really starts to bite. And that's, when the economic consequences start to become more bite more. As the effects elevate, I think you'd expect to see more impact in financial markets. So the longer it goes, the bigger those effects are likely to be. As I said, for Canada on the growth side, there's a variety of effects. We're a net exporter of energy. We're a net exporter of fertilizer. Higher prices means more income coming into the country, but for consumers or any business buying those products, those costs are up. They're getting squeezed. So, and then look, on inflation, the impacts in the near term are pretty clear. When we get the March CPI report, it's going to show inflation's higher. The issue for us, though, is not really about the near term. I realize that's going to impact Canadians. Unfortunately, there's nothing we can't fix the war. What we can do, though, and what we will do, is we will ensure that if energy prices stay high, that does not become ongoing, generalized, persistent inflation.
Okay, let's go to the far side of the room now, and I'll call on Kevin Carmichael from The Logic, please.
Good morning. The bank's been doing a lot of work on supply shocks since the pandemic. I wondered if you could talk us through how you're applying some of the work that you've been doing to the situation we're in now.
Well, I mean, maybe, Kevin, I could say a few words about the things we're watching, and I'll ask Caroline in a minute to say a few words about how we're doing that. As I've highlighted, there are really two main developments. Obviously, the new development is the war in Iran. And as I've stressed, inflation's going to go up in the near term. What we're focused on is, we need to guard against that spreading to other goods and services and becoming persistent inflation. So what sort of things will we be watching? Well, like obviously you look at the total CPI, that's our target. Does that initial increase look like it's persisting? Core measures of inflation are very helpful. The core measures will tend to strip out volatile components, like energy. So they'll give you an idea of what's happening to everything else. Is it spreading? If you start to see core moving up a lot, that's a sign that it's spreading. We can also look at the whole distribution of price changes. Is it just a few components of the CPI that are driving inflation up, or is it many components? The more components, the more worried we'll be getting. And importantly, we'll be looking at inflation expectations. The other thing, which we've been assessing for some time, is the impact of tariffs on the economy. And there, I mean, we're looking at how much slack is in the economy, what's happening to employment, what are business investment and hiring intentions, how, are we seeing spillovers from the hard-hit sectors to the rest of the economy? And then ultimately, how is that impacting inflation? If that is weakening the economy, how much downward pressure is that putting on inflation? So we will be using models, and we have been developing models with more sectoral detail, and that's very helpful when you've got a shock that's going to have very different sectoral impacts. We'll also be using various data sources. Why don't you say a few words about how we're actually going to do that?
Yeah, I'll do that right away. I want to just add to what the governor's said too, Kevin, is one of the things, we're getting better at assessing supply shocks for sure, and our colleague, Deputy Governor Kazicki, recently gave a speech that kind of elaborated on our thinking there. But one really important thing to keep in mind is what's the starting point when you go into a supply shock. When we went into the supply shock coming out of the pandemic, the economy was overheated. That made it easy for prices to get passed on, price increases to get passed on that were coming from a supply shock. We're not in that same situation now, so that's something we have our mind on too. What's our starting point going into the supply shock? To come back to the other point, this is an environment where we put a real high price on really high-frequency data and near-term data, and on things like our surveys and our outreach. So we get out into the economy and we talk to businesses to understand what they're seeing and how they're reacting to supply constraints. I'm going to spend all of next week in Manitoba. One of my colleagues was just in Fredericton. We've got trips planned across Canada. That helps us a lot to get out there and talk to businesses. So that's one of the things we'll be doing. And then we've gotten better at using high-frequency data too, so bringing in micro data on price adjustments and that sort of thing. So that'll help us detect this potential for prices to move from energy into other goods and services faster, and we'll be able to react faster.
All right, next I'll call on Pramit Mukherjee from Thomson Reuters.
Good morning, Governor. In the opening statement, you have said that you will look through the war's immediate impact. I mean, can you tell us how long will this immediate be? 2 weeks from now, 3 more weeks, or 6 weeks when we reach your April 29 decision?
Well, I don't think you measure this in weeks. I think, we get CPI data monthly. Most of our data comes monthly. So, we're not looking at this in terms of weeks. As Carolyn just underlined, we're starting in a situation where inflation is close to target, core measures have been decelerating, there's excess supply in the economy. So we've got some time to assess. We don't think, against that background, we don't think we're going to see rapid pass-through of higher energy prices into broader prices of, broad goods and services prices. So we've got some time to make that assessment, and we've just outlined the things that we'll be looking at. And as I underlined, you got to look at the situation of the whole economy. Obviously, we're going to be looking at developments in Iran. How long does this conflict go? How disruptive is it? How high what happens to energy prices? How high do they stay for how long? That's not the only thing going on in the economy. We're facing higher tariffs. There's still a lot of trade uncertainty. We'll be assessing that part as well. Looking forward, I don't think I can say it any clearer. As those risks evolve, as the economy plays out, we're prepared to respond as needed. What does that mean? Well, yes, we could keep holding the interest rate where we are, but look, if energy prices stay high and we start to see evidence that it is generalizing and becoming more persistent, we can raise the policy interest rate to cool inflation. On the other hand, if energy prices come back down, we see weakness in the economy. We see more weakness in the economy. We can lower our policy rate to add more support. I think the message is there's a lot of uncertainty there. We'll be following those developments carefully and we'll respond as needed.
All right, I've got a couple more on the list here in Ottawa. Let's now go to Paul Vieira from the Wall Street Journal, please.
Good morning, Governor. Do you think officials would have talked about more accommodative rate policy to address weakening economic conditions were it not for the war in Iran?
It'd be great to talk about a different economy than the one we're actually facing. But, as I said, we need to look at the whole situation. Certainly, as we've highlighted, since we published our January report, the employment. We've seen declines. We've seen more job losses. It's really largely reversed the job gains we saw through the fall. There's a lot of volatility in the export data, so you got to sort of look through the noise. But exports look, even looking through the noise, exports look soft. The housing market remains weak. So, when we look at the data today compared to what we forecast for Q1 growth back in January, it looks like it's going to come in lower than what we previously forecast. So the risks are tilted to the downside on growth. I think to get to your question, looking forward. We don't have much data yet for this year. We're just starting to get it. We would be looking at, well, how is that risk materializing? And yes, if it was materializing further and we didn't have inflationary pressures, I expect we would be talking about lower rates. But we're operating a world where there's more than one thing going on. We're now facing increased inflation risks, and those two things go in opposite directions for monetary policy.
And we'll wrap up here with Eric Hertzberg from Bloomberg, please.
Hey, good morning. Gasoline correlates pretty strongly with inflation expectations, and the inflation spike of 2022 is not really a distant memory. Neither are the bank's hikes at that point. How worried are you about the spike in oil prices pushing Canadians' inflation expectations higher? And to pile on Greg's question, how would the bank respond if inflation pressures are sustained and growth remains weak?
We saw the biggest increase in inflation we've seen in the last 40 years, a couple of years ago. I guess a little more than a couple now. And what we saw then is that households' near-term inflation expectations did go up with actual inflation. Fortunately, their longer-term expectations remained well anchored, and that actually was very important in allowing us to get inflation back down relatively quickly without causing a recession. We do focus a lot on longer-term inflation expectations because if those do become unhinged, it becomes much harder to get inflation back down. That's what happened in the 70s. Unfortunately, the world was hit with a couple of big energy price shocks. Monetary policy was inadequate, and so we had a decade of high inflation, and that caused inflation expectations to shift up, and that made it very hard to get inflation back down. That's exactly what we want to avoid. We are prepared to look through the immediate impacts of higher energy prices on inflation, but we are not going to allow that to spill over and become persistent inflation.
Okay, that's it for Ottawa. We will now go to those reporters who joined us remotely. I'll just remind you, folks on the line, please come off mute only to ask your question, then go back on mute as soon as you finish so everyone can hear the response. Let us start with Barbara Schechter from the Financial Post, please, followed by John McFarland of Yahoo Finance.
Hello, thank you for taking the question. I just wanted to ask about sort of the going back to the pandemic, which you were just touching on, and sort of ascertaining when to move, because there was a lot of criticism at that time. How do you know when to make the move to if things are bleeding out and they're going to be more persistent? How can you sort of assure Canadians that you know this time when to make that move? And sort of as a follow on to that, we've heard a lot of commentary about how it's not cut and dried. Sometimes you may have to move in a direction that seems to be counter to what you would normally do. Things are different. There's structural change. So if you can address that in the question as well, how do you know when you're making the move at the right time, and what is that move? It seems less clear than it's ever been.
Well, I think I'd start with something Carolyn just emphasized. There are some very important differences from the situation we are in today than the situation we were in coming out of the pandemic. Coming out of the pandemic, there was huge pent-up. I mean, we all remember we couldn't buy many of the things we could, especially services that we couldn't. Things were closed. We couldn't get them. Coming out of the pandemic, there was huge pent-up demand. People also had a lot of accumulated savings because they hadn't been traveling, they hadn't been going to restaurants. There was huge pent-up demand. So, as the virus faded and we all got vaccinated, life got back to normal. There was a huge surge in demand. Supply was still disrupted. It couldn't keep up. And then on top of that, Russia attacks Ukraine and drives global energy prices higher. So that came against a background when inflation was already above target, the economy was overheated, and there was considerable pent-up inflationary pressure. This energy price shock, first of all, we'll have to see how long it lasts, how persistent it is, how big it is. But the other thing I would emphasize is it is coming against a background of an economy where inflation, we've been close to 2% inflation for more than a year now, about a year and a half. We've been within the 1 to 3% target for 2 years. The latest reading on CPI inflation is 1.8%. Our core measures have been decelerating. So there isn't a lot of sort of pent-up inflationary pressure in the economy. So against that background, we don't think this is going to spread quickly. So we've got some time. But, as I've highlighted, if energy prices stay high, particularly if they go even higher, yes, that does increase the risks. And what we can't do is let that become persistent inflation. So I can't put that on a calendar. It's going to depend on what happens with the war in Iran. It's going to depend on what happens with energy prices. What I can say is, I think we've outlined clearly the things that we will be following to make those judgments. And we will be updating you, at each meeting on what we see there.
The other thing maybe I'll add is just back to Kevin's question about getting, we've had a lot of practice really in looking at supply shocks more recently, so getting better at assessing them. And we've talked a lot about how the duration and whether or not this conflict in Iran spreads will have a big impact. So if you think of the Strait of Hormuz, that could get reopened. If things are resolved quickly, the strait reopens and oil and other commodities start moving, that'll be a quick bounce back. But as we see infrastructure damage in the region, that will take longer to remedy too. So we know that some of the supply can come back quickly, but not all of it. So things like that will matter as well.
All right, next is John McFarland from Yahoo Finance, please.
Hi, thanks so much for taking our questions. So it's understood that higher oil prices will benefit energy-producing regions in Canada especially. But we've also got manufacturing regions suffering, and economists saying housing markets in some of the largest cities in Canada, which are outside of the energy producing regions, are possibly in recession. Highest level of mortgage arrears since 2012 in Ontario, with mortgage renewals, a wave of them with rates looking like they're going to go higher. So how is Governing Council thinking about setting a single policy rate given increasingly divergent regional conditions?
Look, you're right. When energy prices change, when you get sectoral tariffs, these have very different effects on different industries, and those industries tend to be regionally concentrated across the country. So yes, some communities will be certainly harder hit than others. Some will even benefit from higher oil prices. That's not something we can address with monetary policy. And we've got to look at the situation in the whole economy. We have one target, and that is inflation for the whole country. What you do see over time is that inflation across different regions of the country tends to be pretty similar. It's not every month exactly the same, but if you average over a year or two, inflation in any province is pretty similar over time to the national average. Our job is somewhat limited. It is to keep inflation low and stable for the country. That will, if you do it on a national basis, it will work for the country as a whole. That will be our inflation target is our ultimate beacon.
Okay, next.
Okay, we've been listening live to Bank of Canada Governor Tiff Macklem taking questions from reporters after deciding to maintain that policy rate at 2.25%. Huge emphasis and focus really today on that war in the Middle East and, of course, the oil prices being driven up and what that does for consumers here at home and the Canadian economy. Macklem referenced heightened uncertainty related to U.S. trade policy as well and geopolitical risks and said the new layer of uncertainty is what we're seeing unfolding in Iran. Macklem also talking about inflation here in Canada, close to 2% for more than a year, but food inflation remains elevated. He's also saying with the economy in excess supply, CPI risks looks contained, but their conversation kept going back to that war in Iran and what that's going to do. Tiff Macklem saying, obviously, it's driving up oil prices, which will push up inflation in the short term. He says the duration of this war is key in terms of how this affects the Canadian economy, because obviously with higher oil prices, some Canadian companies could be benefiting from exporting both oil and fertilizer, but consumers would obviously be feeling the squeeze of these higher oil prices. One other thing Tiff Macklem said that I thought was interesting was, quote, if energy prices stay high, we will not let their effects broaden and become persistent inflation, possibly a hint of what could be coming in the next couple of months in terms of rate cuts or rate hikes to help the Canadian economy. So for more on this, we're joined now by Bloomberg Intelligence U.S. and Canada economist Stuart Paul to break down what we just heard. Stuart, I know you've been standing by as well, listening in to Tiff Macklem, speaking with reporters and Carolyn Rogers. I'm wondering what you think of what you heard and how the Bank of Canada is thinking about the inflation pressure created by that rising energy prices and the war in the Gulf.
It's really interesting, at least to my ear and in my reading of both the policy announcement and the opening statement, it looks like the Governing Council is pretty comfortable reading through the near-term inflation pressures that are coming from the global energy supply shock. And instead, they're focused on downside growth risks. As you pointed out, of course, as an energy exporter, Canada has the potential to benefit some from higher global energy prices. But I think the thing to focus on is that Canada's exports, the actual volume getting exported by Canadian energy producers, is going to be limited by pipeline capacity. The big three pipelines, Enbridge, Trans Mountain, Keystone, are close to running near 90% capacity right now. Canada is also limited by U.S. refining capacity. And I think the central bank members, the governors and deputy governors, recognize that the actual potential for Canada to capitalize on this moment is pretty severely limited. So instead, what's more likely the issue at hand is just how much higher consumer energy prices weigh on real economic activity domestically at the consumer level. And I think for that reason, the central bank is going to be comfortable maintaining that 2.25% policy rate throughout most of the year, just providing a little bit of gas to the economy, a little bit of accommodation throughout most of the year.
That's so interesting. Yeah. And as Tiff Macklem kept saying, right, is that the really what happens with the Canadian economy in terms of these high oil prices depends on the duration of this war as well. But no doubt uncertainty seems to be the thread still running through the policy announcement. We've heard that in the last couple of announcements based around uncertainty around trade. Now there's some added layers. The opening statement and the press conference talked about uncertainty. What do we know for certain, though, about current economic activity and the outlook that can actually guide investors?
It's a great question. So there is a lot of uncertainty around policy decisions, around global conflict, around global trade. What I think is most certain now is that there is increased pressure on U.S. President Trump to finalize a USMCA deal to limit some of the trade uncertainty, particularly in the U.S. Midwestern states. So I think that actually poses a benefit to the Carney administration. It should make negotiating that USMCA trade deal a little bit easier come the middle of this year. What else do we know for certain? There is slack in the labor market that's going to limit core inflation pressures. There's going to be some downside core price pressures coming from the crowding out of economic activity created by higher energy prices. And I think Canada's capacity to export additional energy to the rest of the world is going to be limited, especially in the near term. And when that's the case, I think that the Bank of Canada is well positioned to just keep providing a little bit of gas. When it comes to certainty around the trade outlook, when it comes to certainty around economic activity, I think that what will matter most really in 2026 is fiscal policy. And right now, if Prime Minister Carney can just basically stick to his knitting with the budget and focus on cutting red tape, building homes, he'll be providing a more substantial amount of gas to the Canadian economy, more substantial amount of accommodation in the form of fiscal policy, and we'll actually see an acceleration in domestic economic activity separate and apart from the energy industry as we head into year end. And at that point, I think the central bank will be a little bit more comfortable hiking, but not in the near term and not in response to high energy prices.
Okay, Bloomberg Intelligence U.S. and Canada economist Stuart Paul, thanks so much for your insight and thanks for standing by while we listen to that press conference. Appreciate it.
Thank you.
And that wraps up this edition of The Open. Morning Markets with Roger Peterson is up next.